Roberts with International Tax Advisors, Inc., bringing you another episode of Tax Briefs. Previously, we've discussed two layers of taxation, and that is generally one level of tax at the corporate or business entity level, and another layer of tax when those remaining earnings are distributed to the individual and taxed at the individual level. Moving more into the international stage, talking about a concept called double taxation, and this generally refers to a resident country's ability to tax a source's country profit. And so let's take Mexico, for example. If foreign corporation was set up in Mexico and earned $100, it would be subject to Mexican corporate entity level taxation, which is 30%. And so they would pay to the Mexican government $30, equal to that corporate level of taxation. Mexico would have its own domestic second layer of tax, and it would apply that via withholding. And so in this case, if they're sending back a dividend after 30, that would give them $70 to send back as a dividend. That dividend would be subject to a 10% withholding rate. And so 10% on 70 is $7. This withholding is the local country's mechanism to create these two layers of tax. So we have two layers of tax just within Mexico, the entity level taxation and then the shareholder level taxation, which is taken out via withholding. Then once the remaining profits get back to the U.S., so 70 minus the 7 is the 63, it's then subject to tax again in the resident country. And this is because the U.S. taxes its individuals on worldwide income. So the Mexican source income is subject to tax in the U.S. again. Now, this other taxation in the U.S. is what referred to as the double taxation. So it was first subject to Mexico, two layers of tax, and then the U.S. taxation as well. This double taxation can be mitigated, and that's what we're going to talk about in future tax briefs. Generally, a couple ways to think about mitigating this when using tax and planning. The first would be foreign tax credits. That is, the U.S. Provides you an offset for its tax based on how much tax you pay to the Mexican government. So foreign tax credits are one mechanism. The other mechanism is a tax treaty. If these two countries have an income tax treaty, you may be able to reduce the withholding on the way out to the U.S. And sort of a sub thought between tax treaties is funding, and that is whether you choose to capitalize this entity with equity or debt could determine how much withholding is applied on the way out. So if this is dividends on equity, it may be 10%, but if it's interest paid out on debt, it may have a lower withholding rate. So we may be able to mitigate some of these, this double taxation. Now you can see from an overall level, this same $100 of revenue is subject to $30 of Mexican corporate level tax, $7 of withholding, and potentially, if this is a qualified dividend, 20% in the U.S., and so that would be 12.6. And so we have $49.6 of tax paid on 100. That's an effective rate of 49.6. That's obviously very high, and so that's why planning and strategy are very important.